Evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Today, we're going to be going through an actual tax return and talking about how to complete the Fannie Mae Form 1084 for self-employed income. So we're going to do an actual self-employed income analysis here. Give us just a minute, though, to go live on all the different platforms. We appreciate everybody tuning in nice and early. I see the comments were already coming in there. Appreciate that. Everybody, as you tune in, go ahead and drop a comment there. You can also drop any questions that you have in the chat as we go through the presentation here shortly. Let's see, comments coming in. Thank you. Thank you. All right. So it looks like we're live on all the different platforms. So we'll go ahead and get started. Remember, keep dropping comments there in the chat and drop any questions you have in the chat as well. But we'll go ahead and get into it here. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and every Tuesday and Wednesday evening at 7 p.m. Eastern, we do our loan officer training on a different loan topic. And tonight, as I was saying earlier, is going to be on completing a 1084 self-employed income analysis. So I will turn it right over to our sales manager, Jose, with 28 years of experience as a loan officer and a realtor and plenty of experience doing self-employed income for a lot of his borrowers. So you can go ahead and take it away, Jose.
Good evening, everybody. Thank you for joining us. Tonight is a special training because I will let you know once you master self-employment borrower income analysis, you will definitely be in the top echelon of your profession. I remember when I first got started, oh man, we would get these tax returns, self-employed borrowers. You'd have to go to like the self-employment income specialist, some processor that was usually way behind on their work because they were the only person that everybody went to dump this kind of stuff off on, and just didn't make sense, right? It's not that complicated, obviously, unless you get a really complicated tax return like the one that I'm going to treat you all with tonight. But it's pretty basic. Once you follow the steps on the form, certain lines, fill in the blanks, that's good. But first, you need to know what you're looking at, right? It's not just as simple as fill in the blanks. You got to know what you're filling in. You got to understand the concepts. And that's what we're going to get into a little bit first here. And then I will break down for you some income analysis and show you how we do it, right? So let's jump right into it because I want to get into the meat and potatoes of the matter. So, talking a little bit about what are the key components of your borrower's income, right? We're keeping it a little bit general, right? We're talking if you're a salaried or hourly employed borrower, we're going to be dealing with wages, salaries, overtime, bonuses, and we're going to be worried about stability of that income. If you're a self-employed borrower, then we're talking about the business profits and losses. We're also going to be dealing with tax returns and financial statements and business sustainability. And then whether you're self-employed or whether you're salaried or hourly, there are going to be other sources of income as well that are going to come into the picture, like rental income, which is usually on the Schedule E, unless it's a partnership. Then you're going to be looking at the Form 8825. You're going to be looking at investment income as another source of income, and then you have alimony, child support, or other type of support payments, right? Could even be disability, some type of help from the government, any type of other sources of income that occurs on a recurring basis. Can't be one and done on those. So what what type of documentation requirements do we have for our different borrower types, and then we'll go into specifically self-employment. So our salaried hourly borrowers, we're going to be more concerned with pay stubs, right? And we're going to use always the year to date figure. And typically we're going to be required for 30 days worth of pay stubs, right? To get that monthly income amount. We also have to worry about variable income from our salaried or hourly borrowers. Variable income could be overtime for our hourly borrowers, tips, commission, right? Which could be applicable for salaried or hourly as well, depending on their pay structure. Bonuses, which is also could be for salaried or hourly. These usually require 2 years documentation or a guarantee that it will continue if we have documented 1 year, but less than 2 years. Our salaried hourly borrowers are also going to have W-2 forms. So we're going to need 1 or 2 years, depending on the loan program, if it's non-QM, or on the AUS findings, if it is an agency loan that uses either LP or DU. Our self-employed borrowers, we're going to be reviewing tax returns, profit and loss reports, financial statements like income statement, balance sheet, and 1065 partnership report. The tax returns we're talking about are self-employed borrowers could be either an S corp, which would be an 1120S, or a C corp, which would be an 1120. That plus their 1040. So not just a 1040, 1040 plus the corporate tax return and any partnership returns, which are the 1065. As mentioned, rental income is derived from the Schedule E for properties on the tax return, 1040. If it's a 1065 partnership report, there's going to be an 8825 form. We also have Schedule E incomes, rental income calculators that you can use, the same as we use for the self-employed borrowers. I think the Freddie Mac form is the Form 92 for rental income calculation. I can't recall right now the Fannie Mae, but I am going to show the page with all the income calculators before we actually get into breaking down the income calculator. For rental income, you're also going to need leases for existing properties and for properties just put into service that are not on the tax return. However, remember the actual rental income that we're going to be using is the rental income that was actually reported on the Schedule E form. So the lease could say $1,200 a month, but if they put $9,000 for the whole year, that's what you're going to use. 9,000 divided by 12, whatever it is. Then we have our other income, which could be documented by a Social Security awards letter, the pension awards letter, the divorce decree and property settlement agreement. When you are using child support or alimony payments, keep in mind that usually you're going to have to show a certain number of months of having received that payment into your bank account, into the borrower's bank account, so that you can use it. Just because it says it on the property settlement agreement or on the divorce decree doesn't automatically guarantee you're going to get the credit if you can't show it going into the account. When we are calculating that salaried or hourly income, when in doubt, use the income calculator. There is a specific income calculator for these types of loans. For self-employed, we would use the Form 1084, like I just mentioned, for Fannie Mae, or the Form 91 for Freddie Mac. We always use gross income, not net income. Any employment gaps more than 30 days will need to be explained, letter of explanation up front. Let's be proactive. Don't wait for underwriting to ask you for it, because instead of asking you for it, they may just suspend your deal because they had no idea what was going on. Remember, when we are calculating that salaried or hourly income, we're going to use the year to date income, especially for hourly. We're not going to use the number of hours worked per week times the hourly rate. Because what if that borrower didn't always work 40 hours, right? What if they worked 37 hours some week, 35 hours some week, 34 hours some week, and 40 hours some week? It's not going to be 40 hours times the hourly pay to get the weekly times 52 divided by 12. That'll give you the max that they could be making if they worked all 40 hours every week of the year and didn't miss a day. Not always the case. Then, when you're doing your calculations, determine if they're paid bi-weekly, that's 26 pay periods, or bi-monthly, which is twice a month. And I mentioned again variable income. It has to be averaged usually over 2 years. Keep in mind that if the average is declining, or should I say, if the figure is declining, meaning, for example, 2022 was 10,000 and 2023 was 5,000, you're not going to get 15,000 divided by 2 and come up with 7,500. You're going to use 5,000 because that's the lower amount. It's the most current amount. And now, if it's the other way around, if you had 5,000 in 2022 and 10,000 in 2023, then you are averaging. It's the trend is up, and then you're at 7,500. So let's talk a little bit now more in depth about our self-employment income. Before you dive into that 1084, if it's a Fannie Mae loan, or the Form 91, if it's a Freddie Mac loan, you're going to need to know what type of business you're dealing with. Now, in this tonight's exercise, we are breaking down the 1084 form, but I'm going to give you a very strong suggestion. Freddie Mac is friendlier towards self-employed borrowers than Fannie Mae, and it boils down to the Schedule K or the K1, excuse me, and the distributions versus the ordinary income. Uh, why is that? Because in the Schedule K1, let's say, for example, you have $100,000 as the ordinary income, but you have $20,000 in distributions. Once you get to the end, to the part of the form where you have to make a determination, which is the actual income, Fannie Mae says you're going to use the lower of the two figures as the actual income. So if your distribution is 20,000 and your ordinary income stated is 100,000, you're going to input 20,000 in that part of the form instead of 100,000. That's a mind blower, but that's what happens with Fannie Mae as opposed to Freddie Mac. And this is why you would choose Freddie Mac over Fannie Mae, usually, not always, but usually with a self-employed borrower, because Freddie Mac says if the ordinary income is 100,000 on the Schedule K1, but the distribution is 20,000, Freddie Mac will let you use the $100,000 amount as the income if the business has liquidity, right? So you would go to your liquidity calculator and you would plug in the numbers. And liquidity, is basically assets minus liabilities equals a number. And if it's a positive number above zero, then the business has liquidity. And Freddie Mac lets you use $100,000 instead of $20,000 as the income. However, if you do the calculation assets minus liability and it's a negative number, that means the business does not have liquidity and you have to use $20,000 as the income that you input in the form instead of 100,000. Now that could be a really big deal with your loan here on which one to use. So typically, like I mentioned, Freddie Mac is going to be a little easier if you have that type of issue. So make sure that you analyze your tax return well and do the income calculation so that then when you do place your loan, you can make sure you lock it in as a Freddie Mac instead of a Fannie Mae, and don't get surprised when the underwriter tells you, oh, your deal is suspended because your DTI is 148%. That's not going to work. So again, determine the business type. Right? If it's a sole proprietor, meaning somebody that is not incorporated, doesn't have an LLC or anything like that, then you're going to be dealing with the 1040 and only the Schedule C on the 1040. And one number you want to keep an eye on in the Schedule C is the non-recurring other income or losses. Why is that? Well, because if it's a non-recurring loss of $18,000, then you would want to get an explanation from the borrower's tax preparer as to what was that loss. Most of the time, non-recurring losses are either a one-time deal or they're a paper loss, right? It's a carryover loss. They may have had a loss 5 years ago, and instead of, it was better for them to amortize that loss over 5 years so they could do that. However, you're not gonna you can exclude that non-recurring loss then if it's a carryover loss. The same way if it's a non-recurring income, you're probably not going to be able to use any non-recurring income because that meant it's a one-time deal, right? So you can't do a one and done and use it for income because it has to be a sustainable income. If you're dealing with a partnership, you're still going to be looking at the 1040. You're going to have to look at the K1, right? The K1 shows the distribution of the income. It shows their percentage of ownership. It shows ordinary income. It shows if there's any distributions and a couple other items on there. But the main thing you're going to get from the K1 is their percentage of ownership in the entity plus ordinary income plus distributions. S Corp is you're going to have to review the 1040, the Schedule K1, W-2s. Now, when I mention W-2s here, like as well as in the partnership, it could be W-2 from regular employment, or it could be W-2 from their own company. A lot of times we run into that situation. We have somebody who has a company, 11, could be an S Corp, C Corp, whatever, but usually this happens when it's an S Corp. They have an S Corp. They're more than 25% owner, 25% or more owner in the S Corp. They get paid. They pay themselves with pay stubs. They give themselves a W-2, and they'll start, telling you, oh yeah, I'm an employee of ABC company, but ABC company happens to be, a company that they have at least 25% ownership. If it's an S Corp only for this, then they're self-employed. The fact that they have a W-2 from the company of which they own 25% doesn't take away from the fact now that they're self-employed. They're paying themselves. That's all it really boils down to. So that would be a self-employed borrower for all intents and purposes of what a self-employed borrower is for your loans. If it's a C Corp, it's a little bit different. As far as agency loans and most non-QM options. Now, when you're going non-QM, I do stress you have to look at the guidelines for the particular option, because we actually ran into one where we were arguing the C Corp argument that we use for agency loans and for most non-QM outfits out there. And this conduit actually had embedded deep in their guidelines that on a C Corp, if you're 25% or more owner, they consider you self-employed. That's how they decided to do it. They have a right to do it, but frankly, for all intents and purposes of the law and what is a corporation, they're not correct. So we just had to grab the loan, take it out of there, put it in another conduit, and we closed it without any issues because my borrower has some stocks in a C Corp, right? He owns a percentage of a C Corp stocks because a C Corp is a true corporation. It's an entity unto itself. Nobody owns a C Corp. You own stock in the C corp. However, if you own 100% of the stock of the C corp, then any income or losses from that C corp will pass down to the borrower. So an agency, which is Freddie, Fannie, VA, FHA, and most non-QM outlets out there, that's how they're going to view C corps. So if your borrower has a C corp and doesn't own 100% of the stock, but it had a $200,000 loss, no worries, you'll be okay. However, if that borrower owns 100% of the stock and that C corp had a $200,000 loss, then I think it would be a time to go bank statement or profit and loss, or if they have a lot of money in the bank, asset depletion, right? Or if it's an investment property, DSCR. Because if they are 100% owner of the stock in the C corp with a $200,000 loss, hopefully they made a lot of money because, they need to offset that loss. It's about sustainability too, of the earnings. So what do we need to do when analyzing these documents, right? All these documents that I'm, giving you the pointers here, what you need. Now, keep in mind, and which I'll show you in a minute, when we are looking at a 1040, because I've had sometimes where people try to break down the self-employed borrower's income simply from the 1040 and the Schedule 1 page that they see in the 1040, but you're missing a lot of the picture there, because you have to go dig deep and find the items that can be added back to the income. That's the whole key of analyzing self-employed borrower income and analyzing the corporate documents, not the 1040, which is the personal document, but the corporate documents or the partnership documents, to try to see the breakdown of the income and expenses, because some of these expenses can be added back or other expenses result in further deductions, like travel and entertainment, right? IRS lets you write off 50% of that, which means that the other 50% is still an expense. So what happens when we see that travel and entertainment deduction? We hit you for it. So if it's a $5,000 deduction, we hit you with $5,000 more as a deduction off of the income to deduct the other 50%. So what do we have to do when we're analyzing the tax returns, right, for qualifying income? Two primary goals. First, understand the income trends and determine if the income is regular and recurring, right? We talked about the non-recurring income and losses. And there's a part I was mentioning right now with adding back items. Address the adjustments on the tax return that differentiate taxable income from qualifying income. Taxable income is, after the IRS lets you deduct certain things like depreciation, that's a paper loss. Amortization, that's another paper loss. Amortization is business startup expense. Depletion, which is another paper loss, right? Those are three of the most common add back items that can be added back. And another one is mileage depreciation. So what are the important items for you to consider when you're looking at those tax returns and seeing what's going on, looking at the trends? Well, look for declining income and a loss for the year, and determine if it is a one-time event or if it is recurring. Here's where you're going to have to possibly get some explanation letters from the tax preparer. Mortgages, notes, and bonds payable in less than 1 year are large debts payable this fiscal year and are usually subtracted from income unless documentation can be provided that the debt will roll over or that the business has the liquidity to cover the payment. Now, what exactly does that mean about the debt can roll over? Well, one of the most common mortgages payable in less than 1 year are HELOCs, for example, right? It's a revolving debt. It doesn't have a set due date per se. So, but you've always rolled it over into the next year. You're not paying the HELOC off. Well, that's one that if you can show this happens every year with a HELOC, for example, then we're not going to deduct that from the income. Or because any debt that you cannot show that will roll over then gets put into the income calculator as a reduction. So if you have a $50,000 loan that has to be paid off by the end of the year, guess what? There's going to be a $50,000 amount entered in that section of the income calculator, and that means there's going to be $50,000 deducted from the gross income that we're doing, which means we're going to have $50,000 lower net income because of that entry, unless the business has the liquidity to cover the payment, meaning you do the liquidity test, which is going to be basically assets minus liabilities. And if the business has enough assets to cover, it's usually going to be cash in the bank to cover the payment, then we will not deduct it from the gross income. But if it doesn't, it's going to be deducted. And we mentioned recurring losses or income, which are paper losses, carryover, or are they a natural loss due to a decline in business. Business returns must definitely show adequate liquidity. And I did mention looking at the Schedule K1 for distributions, because distributions are very important. So let me break down now a couple of things here. Let me first go. This is one of the sites that we go to for the income calculators. Now, here, the income that I'm going to be calculating today is actually our ex-president Donald Trump's tax returns. Believe me, and I know it was as complicated as it is, I probably would have picked somebody else's, but the other ones that I was looking at didn't have any corporate stuff, and I really wanted to do the corporate part of the income calculator. So I'm a glutton for punishment, right? And I picked the 350-page report. So one thing to note here, it says archived calculators, right? Because when you come to the page, this is going to take you over here, and then you're going to see. Now, this one that says income calculation worksheet, that's for a salary or hourly borrower. It's not a 1084. So it's a little bit different. It talks about W-2 and pay stubs and pay periods and all that kind of stuff. So that one's pretty cool for calculating your salary or hourly borrowers. Then this one is the 1084, the one that we're going to be looking at, but we're actually going to be looking at the 2020 version. And then this here is Freddie Mac Form 91, which is their income calculation for Freddie Mac loan. This is Freddie Mac's Form 92, income calculator for rental income. And then this is the one that you can use, regular rental income calculator for a Fannie Mae loan. Again, right here, actually the 1037. And then the liquidity calculator, either quick ratio, which looks at the liquidity against current liabilities, and then current ratio, which looks at working capital liquidity against current liabilities. So you got two of those. So our cheat sheet is to, how to use the form. And then here is archived calculators. So I went and grabbed, I think it was the 2020 and 2019 calculator is the one that I grabbed. So now these tax returns that we're going to be looking are public information. I don't want anybody to think that, we're doing anything illegal here. You just go right here, it's presidential tax returns. And these are all these people that filed theirs. There's 45 people that filed theirs. And maybe if I would have looked a little bit deeper, I wouldn't have picked Donald Trump's, but I did. I got it. And let's just deal with that one, because it's busy. Now, his 350-page 2020 return, which is the newest one that he filed. So what I want to note here, and let me make it a little bit bigger here so that we don't have to stress to see this, is that when you're looking at the 1040 for your borrower, right, start looking through it so you'll note if you're going to need to get the self-employed borrower income calculator, because it may not always be obvious, right? Because your borrower is telling you, "Oh no, I get W-2s from my business, and or I get W-2s. I'm a W-2 employee, and I got pay stubs, right? They don't make any. Normally, it's going to be they don't make any mention of a business. I'm an employee of ABC, right? So okay, you're thinking they're an employee of ABC, right? And then you start looking at their tax returns, right? I mean, there's going to be several telltale situations. First, line number 8 here that says other income from Schedule 1, line 9. So you're like, there's something going on
Jose,
here.
can you click the 3 lines in the top left? Make some more rooms for yourself there.
Okay.
And then zoom in a little bit more, maybe.
All right.
And then you can full screen this as well in the top right, the 3 dots there. The other one above that. Yeah, you can do full screen there. That might help us a little bit.
Okay.
Under zoom. Next to zoom.
I'm sorry, I don't see it. Here we go.
To the right. That button.
All right.
Yeah, that allows you to zoom in a little bit more for us.
All right. Cool.
There we go. Perfect.
Okay.
Beautiful. Thank you.
for the other Jose's out there, right? All right. So here we have now when you see the Schedule 1 with $15 million loss, you're like, okay, wait a minute. There's something going on here. Let's look a little deeper, right? Because if he was just pure wage earner, you'd be looking at number 1, right? And now, obviously, you could have tax exempt interest, qualified dividends, IRA distributions, pension annuities. All these things are other, and even capital gain or loss from a Schedule D. But none of those have to do with self-employment, right? Self-employment. Now you start looking at the Schedule 1, and you should start wondering, okay, what's going on here, right? So then you start going to our, let's make it a little smaller now. These pages aren't all the same size, and now this should be our Schedule 1. And then look at what we see here, right? Business income or loss attached, that's the Schedule C. So that's going to be in the 1040. So that's already showing self-employment activity. And then right here, rental real estate, royalties, partnerships, S corporations, trusts, etc. attached Schedule E as applicable. That's where our $15 million hit right here. So all of this is a 15,825, which should be what is on this page, right? 15,825, 345. So at this point, you know that the borrower has something else going on. So you're going to have to ask the borrower for their other documentation.
So at face value here, it looks like he doesn't qualify for any kind of loan with tens of millions in losses, correct?
Correct, right? So this is why.
So we're going to come to a climax here when we get to the bottom line, it looks like. So.
Yep. Now, mind you, this is 350 pages, and he has some other LLCs for 2020 as well that I'm not going to have the time to get into. So there's other stuff going on than simply from the one that we're going to be looking at. But yes, absolutely, we have to see where this ends when the dust settles, right?
Exactly. Just because there's 15 million and only 10 million of income doesn't mean 5 million in losses, right?
Correct, because there's the items that we're talking about that we're going to add back, right? Depreciation is usually there. There may be amortization, and by amortization, we're not talking about the loan amortization. We're talking about business startup expense is what they call amortization. And another common one is depletion, right? And then we mentioned business mileage depreciation. Those are the 4 most common items that we can add back. Now, if they have also in their expenses, that how it tends to be the case with investors, for example, that have a lot of properties, they may have one-time expenses This is why you got to really go into each property. And if they have 40 properties, it's going to be a lot of work. But you're going to have to ask them about the expenses. And are any of these expenses one-time events? Like, did you have to replace the roof? Or did you have a casualty loss, right? But then the casualty loss would be listed as a casualty loss. That's another in the category of depreciation, depletion, amortization. Casualty losses goes together. So they'll put amortization / casualty losses. But you ask the borrower if any of those were one-time expenses, and if, for example, they had to re-roof 10 of the 25 properties that they own for whatever reason, and they can document it, give you, contracts, proof of payment, explanation, and that occurred during that year, there's a good chance that you can get those types of expenses added back as well, right? So there could be a lot going on there if you know the right questions to ask. And then the deductible self-employment tax, that doesn't come into play in our equation. So let's go here into the Schedule C a minute. I think there's multiple Schedule C's here. We're not going to worry about doing the dividends and all that kind of stuff for our calculations, because that's the easy part. But what's not easy about that is that if you do use interest and you do use dividends, they have to be recurring. So you would need to show the trend that it's been, it is a recurring income. So you're probably going to need either extra years tax returns or documentation from the tax preparer that is a recurring expense. Okay, so this is our first Schedule C, and now you'll see in this one 87,442 of gross income. Now, it's under other income, so that's a red flag where you would need to find out what that is to find out if it's an actual recurring deal. This is for management services. Let me actually, what I'm going to show right now a minute is, and I'm going to have to get off of full screen because I can't get to my other items. Okay, how do I do this? Okay, how do we exit full screen? Just all right. Let's first look at the calculation right here. So let's, I was filling out the 1065 portion, but let's go to the Schedule C portion. It should be 1065, 1120S, 1120. Wait, did I pass it? All right, here we go. I went too fast. All right, so Schedule C, profit or loss from business or sole proprietorship, right? So first thing they're asking us is net profit or loss, line 31. Notice here it says non-recurring other income, right? So we come back over here and our net profit or loss from line number 31 is 0. And then this is our line 6, the non-recurring. Now, remember, if we're going to use that, we have to be sure that it is a recurring item, or else we would hit them up with the 20, this expense, but not this. So let's assume that we checked with the accountant and they gave us a explanation that made sense in writing, an LOE for the 87,442. So 87,442. Now, remember I mentioned depletion, depreciation, non-deductible meals, and entertainment expenses. I don't. I think that he had it all in taxes, and licenses, 87,442. So there's nothing there we're going to add back. If he did have the meals, travels and meals, travel is the one we're going to hit him for. So, excuse me, meals and entertainment expenses, not travel. So here we got, he had zero there, zero there, zero there. Didn't have any business miles. At least I don't think I saw any business miles. I mean, it would be here in number 9, but it would also be, if he had it, it would be right here. So he may have declared it on another business, on another Schedule C. So you got that there. So now here's the deal. Now I would need another form for this borrower because he has multiple Schedule Cs, right? So I don't believe that we have here. Let me see. Yep, we can do. Nope, we can only do one Schedule C on this form. So we would have to calculate this number multiple times, right, to get the right number. But I'll go through the exercise in this one just to show you what we're talking about. So here, the business is there, but no entries other than net profit or loss, $5,394. Let's look at the next page. Normally, you would see it here, but that was it, 5,394. And let's see if there's another Schedule C. Another Schedule C. Aviation. And this one has 2440. So again, you could do it a number of ways. Either have your own little spreadsheet where you're putting each section, and then you could be adding them all up and putting them just in this each section in this calculator, or you can have just multiple calculators open and doing that calculation that way. Some of these spreadsheets, income calculators, do have the ability to put multiple Schedule Cs. So let's see, out of curiosity, how many he has. So, okay, because I did mention we're not going to go through all of them, but here's one with gross receipts of sales, 160,144, 160,144 in expenses from line 48. So we go to line 48. So here we have 18,923 as a net profit or loss. Okay, so, and over here, there's going to be probably in this tax return, there's going to be a separate document. It's going to be Schedule 48, whatever it was, way buried back in the end of the tax return. So I'm going to go through these a little bit quicker just so we could get to the end, so we could see that schedule we're talking about and see if there's any interesting stuff there that we can recapture. So far, none of these expenses are any kind of the expenses that we would be able to add back. They would all just be adding, you would just be adding this 29 to each time on the loss line. And let's see here. So now we got a Schedule E. Interesting. Royalties received 133,173, and number A says royalties and number B says royalties. Interesting, because normally the Schedule E is, you have actually properties on there, but in this case they're actually doing the royalties here. Interesting. It works out the same, royalties received, fee, and 88,972 total amount. So your income here, 89,039. there's no depreciation here or anything like it would if this is real estate. So you really don't get to capture back anything, because this is the key that you would look at on a Schedule E, depreciation. Another thing, if this was a regular Schedule E, you'd be looking at mortgage interest paid to banks, and you'd be looking at insurance and taxes. Why? Well, because if they're making payments on real estate and you have a mortgage statement that says that their total payment includes mortgage interest, insurance, and taxes, then those are items that you will add back in your Schedule E calculator. But if they're not included in the monthly payment, you're not going to add them back just because it shows in the Schedule E income calculator. Why? Because they're not paying it with their monthly payment. The only thing you would add back would be interest, because you're already taking that into consideration in the monthly payment, the interest expense. So I want to see, okay, this is your depreciation form here as well. Let's see what, okay, we don't show anything. This is the depreciation, okay, income or loss. Blah, blah. We had the depreciation is on the corporate side. So there's nothing here. Total income or loss, that's where they got that number. And now I just want to see if we see that schedule. Probably not going to run into it here, but let's see. It's a lot of companies going on there. What is this? Nope. Supplemental business expenses. Well, it looks interesting. See all this C statement 3, 4, 5. I think he has like 48 statements in the back of his return. Yeah, definitely. This is like a good borrower to go bank statement, bank statement or P&L or DSCR if they're getting an investment property. This is crazy. So I don't think I'm going to find that document, but let's see. I just want to show it to you guys. Because see, this probably includes state stuff also, which is where you have 350 pages. Business expenses, see statement 6. Wow. Okay, let's. Wow, this is for every company. Carry forward of general business credit computation. Look at that, huh? A lot of stuff going on there. Let's go a little bit more. I think we're almost to the statements I want to see. You're normally not going to have somebody with this type of a tax return. Luckily, usually 30, 40, 50 pages is the limit on most of these tax returns, unless there's state filings as well. I don't think I'm going to get to that document. I may have passed it already. Well, probably. If not, let's go into the corporate tax returns. Well, what I'm looking for is just a statement that's going to break down all the expenses, just so that we could see if there's any amortization, anything that actually says amortization or casualty losses. That's all we're really looking for. So that's probably, I think I'll be able to show it to you easier on the corporate one, because I wrote some pages down already on that one. So let's go to page 1 here. Now, this is the 1065, which is the partnership return, right? So it's very similar in what it's going to ask you for. You have your ordinary income or loss from other partnerships. You have your gross profit, which would be the income for this type of scenario. Other income or loss, which is right here. Total income or loss, which is right here. So, and then I'll show you what the depreciation is, and then I'm going to take you to the worksheet, which I already completed. And then here you have depreciation, right? 3,173,787. Other deductions is going to be on a statement. And let me show you the worksheet. So I didn't, like I mentioned, I didn't do, this is for dividends from self-employment. This is for interest from self-employment, right? This is for self-employment stuff. Schedule B. Now, W-2 income from self-employment, that's if they pay themselves. W-2 income. It's going to be right here. If it's regular W-2 income, not from their own business, it goes in a separate spot. It would just be W-2, that's not their self-employment W-2 income. So in this case, we did I did one of the Schedule C's, right? The 87,442. And then here is the one that I was doing for the partnership that we were just looking at. Notice it says IRS Form 1065, right? So ordinary income loss, $8 million. Now, in this case, it's not exactly on line 1. I had to know what I was looking for, which is the income of the business, the gross income, which is going to be cost of goods sold, right? So this is the revenue, gross sales, minus cost of goods sold, gives us our gross profit, $8,038,431. That's the income that we're looking for here, first one. And then net rental real estate, I grabbed this from another section when I went into the 8825. Ordinary income or loss from other partnerships, right here. Ordinary income or loss from other partnerships. Right? It's right here. 48,520,173. Non-recurring other income or loss, right? 17,491. Other income or loss. We know it's non-recurring. Just got to know that right here. 17,491. And then total income or loss, 40,464,251. But we're looking for depletion, which is not there, right? Because he didn't have any. Amortization or casualty. So depletion right here, nothing, right? Now, we don't see any amortization here. That if it's put on there, it's usually in this other deductions attached statement $10,122,899. We're going to look at that in a minute. And let me go, because I wrote down some of these pages. So I think page 45 is one of the pages I want to go to. Right? Rental real estate income and expenses of a partnership or an S Corp. Right? So actually here, there's some more stuff going on. Right? We have some additional depreciation here going on that I added in there. And do we see anything else? Look at that, 4,213 in amortization. Oh my God. And then we have, I don't know why they have it in different lines here, but they also have 74,010 in amortization. So let me write that down. 010, 4213. So, we got to start adding these things. 74010 plus 4213, 78,223. Now, do we have anything else going on? All right. So let's write these numbers in there. Notice this is amortization or casualty, right? So right there, 78,223. And look at the next page. Now I think I wrote down another page that was of interest, page 199. I was going through this. Here's our schedule K1, right? So there's two people here. One is 99% owner, which is our borrower, and there's another 1% person. Could be the registered agent or however they decided to structure it. So ordinary business income or loss. And where is our distributions? I saw them a minute ago. Look at that, distributions, 10,666,718, or 59 through 345. Yeah, so it's pretty obvious here what's going on. There's no income there, even though you have distributions. So, very tricky deal. And let me see if I find the schedule here. Okay, excuse me. Schedule K1, ordinary income or loss. Actually, I have to put, this is the K1, excuse me. I had input error. So 59,345,973. 59,345,973. Okay, line 2. 2439746. Yeah, okay, I did this incorrectly. Sorry about that, folks. This is the 1065 part here. And guaranteed payments to partners. Nothing here. So now this is the part that is from the 1065 form. These figures here. And then we'll notice that his proportionate share is 99%. So I got 99%. And this is actually a minus. I was like, wait a minute. Okay. So situation looks a little bit not that good, right? So we're definitely going to be going with business bank statements here. There's all sorts of stuff going on. So now this says here, review line 19 for a distribution. Now, this is a Fannie Mae loan. This is not a Freddie Mac loan. So in the Fannie Mae loan, we go with the lower amount. So it's the 59. If this was Freddie Mac, and we're looking at 10,666,718 or 59,345,973, we may be able to use the distributions if the business has liquidity. Now it's going to have a lot of liquidity because we got a lot of losses going on here. That's all going to be intertwined in the balance sheet. So assets minus liabilities may work out, or it may not work out to a positive number. In which case, if it was a positive number, we could input the distributions in our income calculation if this was Freddie Mac. But right now we're doing the Fannie Mae 1084. So it's pretty much got us to about as far as we can go with our borrower, because we'd have to be reviewing his other items, his other returns. But let's see if I can find that document, the statement that we're talking about here. I don't think so. I think it's embedded somewhere in there. It's just one page, unfortunately, and I do apologize that I didn't track it down like I tracked down those other 2 pages, but let's see if I can show. Wait. What's this? No, this is current assets. Oh, you go, our Schedule L. Unearned income. That's nice. Okay, maybe I'll get lucky. No, I don't think we're going to get to see the statement to see if he had anything else we could recapture. Nope, but you guys get the idea. For this borrower, I'm just going to show you a minute how complicated 2020 is. This here is the 1040. This here is the LLC we were looking at. This is another LLC. And another LLC. And another one these are all for 2020. So if we're doing 2020 and 2019, for example, we got to grab these 2. We got to grab these 2. We got to grab these 2, as well as these 2. Now, if this is, for whatever reason, a Fannie Mae loan, conforming loan, I would suggest that you set the file up for a 1-year tax return first, right? Do just a 1 year, get that calculation, because you know that if your borrower has 5 years or more as self-employed and they have decent credit, there's a good probability on Fannie that you're going to get the 1-year findings. And in Freddie, it's an automatic, right? If you're 5 years or more in business, Freddie Mac lets you go with the 1-year finding. So what does that mean? That means set up just a 1 year first, right? Especially if you have a 2019 that's not good and a 2020 that's spectacular, and it's usually the other way around on most people. But if your current year is better than the prior year, go just with the current year. Set up that income, put it in the application, and run it through automated underwriting with the 1 year more favorable income. Right, you're gonna have a lower DTI, you're gonna have a lower risk file, and then there's a probability you're only gonna get the 1 year's finding on Fannie and on Freddie. If you know that the borrower has been in business self-employed for 5 years, Freddie Mac has that written into their findings. So they'll say if the borrower has been 5 years or more self-employed, then you can use just a 1 year tax return. So just set it up as 1 year, get the favorable, get the favorable income, and get your approved eligible. Don't automatically average out a bad year and a good year in hopes that your borrower is going to qualify, right? You got to work smart as well and use the tools and the benefits that are given to you. And if Freddie says you're in 5 years, you only got to provide 1 year tax returns, then don't give the 2 year calculation in your application. Do just the most current year calculation.
All right. Don't see any questions that popped up yet.
We got to have somebody out there doing a self-employed borrower loan that has some questions, needs a little guidance.
Yeah, just make sure you guys check out the links there in our Knowledge Center that will lead you to those calculators.
Yeah, just go search keyword income calculator, and it'll take you right to the article. And when you click on the article link, it's going to take you right to all of those different calculators there that I just showed you.
All right. Well, we got no questions. Well, thank you, Jose. Looks like Kyle's already out of here. So we'll be back tomorrow with the Freddie Mac version at 7 p.m. Eastern. So we'll see you then. And thank you, Jose. That was a long one. Hopefully we can make tomorrow shorter.
All right. Sounds good. Thank you very much.
Thanks, everybody.